Good day, everyone. My name is Crystal Jane Taylaran, and my group members is Chinilyn L. Cabatuan, Wilmer D. Labinoy, Jessamay O. Mindo. Today, I will discuss about investment risk. What is investment risk? Investment risk is defined as the probability or uncertainty of losses rather than expected profit from investment due to a fall in the fair price of securities such as bonds, stocks, real estates, etc. Each type of investment is exposed to some degree of investment risk, like the market risk. The loss in the investment amount of the default risk, the money invested is never returned back to the investor. There are 9 types of investment risk. 1. Market risk. 2. Liquidity risk. 3. Concentration risk. 4. Credit risk. 5. Reinvestment risk. 6. Inflation risk. 7. Horizon risk. 8. Longevity risk. 9. Foreign investment risk. Market risk. Market risk is the risk of an investment losing its value due to the various economic events that can affect the entire market. Here are 4 types of market risk: equity risk, interest rate risk, currency risk, commodity risk. Equity risk. This risk pertains to the investment in the shares. The market price of the shares is volatile and keeps on increasing or decreasing based on various factors. Thus, equity risk is the drop in the market price of the shares. Interest rate risk applies to the debt securities. Interest rate affect the debt securities negatively. The market value of the debt securities increase if the interest rates decrease. Currency risk. Currency risk pertains to foreign exchange investment. The risk of losing money on a foreign exchange investment because of movement in the exchange rates is currency risk. For example, if the US dollar depreciates to Indian rupee, the investment in US dollars will be of less value in Indian rupee. Commodity risk. The prices of commodities such as grains or fuels can be volatile in the short term. Commodity price can also follow long cycles, meaning that prices can remain elevated or depressed for extended periods of time. As a result, commodity price volatility is key risk to industries that directly produce commodities or that use them as an input. Liquidity risk is the risk of being not able to sell the securities at a fair price and converting into cash. Due to less liquidity in the market, the investor might have to sell the securities at a much lower price, thus losing the value. Concentration risk. Concentration risk is the risk of loss on the invested amount because it was invested in only one security or one type of security. In concentration risk, the investor loses almost all of the invested amount if the market value of the invested particular security goes down. Credit risk applies the risk of default on the bond issued by a company or the government. The issuer of the bond may face financial difficulties due to which it may not be able to pay the interest or principal to the bond investors, thus defaulting on its obligations. Reinvestment risk is the risk of losing higher returns in the principal or income because of the low rate of interest. Consider a bond providing a return of 7% has matured and the principal has to be invested at 5%, thus losing an opportunity to earn higher returns. Inflation risk. Inflation risk is the risk of loss of purchasing power because the investment do not earn higher returns than inflation. Inflation eats away the returns and lowers the purchasing power of money. If the return on investment is lower than the inflation, the investor is at a higher inflation risk. Horizon risk. Horizon risk is the risk of shortening of investment horizon due to personal events like loss of job, marriage, or buying a house, and etc. Longevity risk. Longevity risk is the risk of outliving the savings or investments, particularly pertain to retired or nearing retirement individuals. Foreign investment risk. A foreign investment risk is the risk of investing in foreign countries. If the country as a whole is at risk of falling GDP, high inflation, or civil unrest, the investment will lose money. Although there are risk investment, this risk can be managed and controlled. Various ways of managing the risk include diversification, investing consistently, averaging, investing for the long term. Diversification includes spreading investment into various assets like stocks, bonds, and real estate, etc. This helps the investor as he will gain from others' investment if one of them does not perform. Diversification can be achieved across different assets and also within the assets, investigating across various sectors when investing in stocks. Investing consistently, averaging. By investing consistently, investing small amount at regular intervals of time, the investor can average his investment. He will sometimes buy high and sometimes buy low and maintain the initial cost price of the investment. However, if the investment rises in the market price, he will gain on the whole investment. Investing for the long term. Long-term investments provide higher returns than short-term investments. Although there is short-term volatility in the prices of securities, however, they generally gain when invested over a longer horizon, 5, 10, 20 years. Important points. It is the risk of losing the money invested due to the fall in the fair price of the security. Securities with higher risk give higher returns. The risk mainly includes market risk but is not limited to market risk. There are other risk types like credit risk, reinvestment risk, and inflation risk, etc. Although investment risk pertains to almost all kinds of investment, this can be reduced by diversification, averaging out investment, and long horizon investment. Conclusion. Investment risk is uncertainty of losing the invested amount. All investments carry a certain degree of risk of loss, but by better understanding and diversifying the risk, the investor may be able to manage this risk. By better risk management, the investor will be able to have good financial wealth and meet his/her financial goals.